Greetings. I'm Mikkel Storsley, Superintendent of Grayslake Community High School, District 127.
And I'm Mike Zellick, Associate Superintendent, Grayslake High School District 127.
And we'd like to do a quick presentation on the 2017 levy information. So first of all, what is a levy? As you probably know, property taxes are one of the primary, if not the only ways, in certain cases, for municipalities to raise revenue for community services. Towns and cities use the proceeds from levying property tax to fund, for example, the public school system, but also law enforcement, emergency service personnel, installing and maintaining roadways, traffic equipment, things like that. And as you can see from the screen there, the levy is the amount of money an Illinois school district requests from property taxes over the prior year. Right? The increase over the prior year is capped at the Consumer Price Index. Most importantly about this screen is that chart. Property taxes make up 73% of District 127's annual operating revenue. So, for all that was made of this new school funding formula, which we think is good, really that's only 21% of our budget, and federal funds are virtually non-existent. So we absolutely rely on local property taxes. That's the way the system is set up, for better or worse, and that's how we fund our schools. So what is the levy's purpose? It's property taxes, as you saw from the previous chart, that is our most reliable source of revenue. It supports all our academic programs. It supports equipment. It supports CTE programs, supports fine arts, supports athletics. Everything that we do in the school, by and large, is supported by the revenue we get from the tax levy.
And that also includes the maintenance of our buildings and our grounds, and creating a learning environment that's good for kids.
Right. So, as we have in the past, we are going to recommend a levy, and we need to do that. We need to do that to continue the high levels of student achievement at Grayslake District 127. In addition, it supports all of our other programs. So that's not just athletics, it's our fine arts, it's our extracurriculars, it's supporting opportunities for students to engage in community service. It's supporting all types of students across the district. So this is not something we take lightly. We understand the great support we get from the taxpayers in our community, and we want to be good stewards of the taxpayer dollar, of course. We also go to great lengths to minimize expenses where we can responsibly do so. Yet there are certain costs we cannot control, and there are mandates from the state and federal government that we must comply with.
And what the recommendation is for the 2017 levy is 4.97%.
Right, but we only anticipate we're going to receive 3.05%.
Now, we know that we also have some new growth in the district of about $4 million, and that's new construction, basically. And that the existing property in the district is going to be increased by about 8%. Now, if you look at the slide in the lower right side, you can see what the overall increase is from the prior year just for operating funds, which is about $780,000, and that represents a 2.1% increase. You can see that matches the CPI, and that is how the funding or the tax formula works, is that, again, we can't ask for more than CPI. However, if you look a little bit further down where it says estimated new construction, about $150,000, that is based on the formula as well, and this is the first time that those properties are coming onto the tax rolls. And we believe that's going to be about 0.4%, again, $150,000, with the overall increase of about 2.5%. Then if you look in the purple box, that's our bonds. Our bonds are increasing and peaking at this time in 2017 of about 5%. So district-wide, you're looking at about 3% increase overall. And just want to point out, again, the new construction and how important it is that we're able to access those tax dollars. Is that, again, these properties have not paid taxes yet on the new growth or new construction. So you can see from the three, it's about $121,000 just with these properties alone. And if we did freeze, if there was a property tax freeze, we would not have access to those new dollars. In addition, these three properties or businesses would have actually a tax reduction only because they would not get taxed on the amount that, again, of the new property. And you can see the levy itself will support each one of these funds. It's an interesting process when you take a look at it as a whole, but these are the parameters that we have to work around, and that's why, again, when we go to more detailed information, you'll see how we break out the different levies for these particular funds.
So you'll see in the next slide kind of how some of these funds break out, and we just wanted to list them just to show that this is a very complex process. The education fund is by far our largest fund, but we have funds for operations and maintenance of the building, bonds, and our interest. Mike had already mentioned a little bit about that. We'll talk more about our bonds in a few minutes here. But transportation, IMRF.
The IMRF is and Social Security actually is for the support staff, and it's a mandated requirement for their pensions.
Then capital projects, some of the larger construction projects around the building, and working cash. Is another fund that Mike can explain that a little bit.
Yeah, the working cash, we have some fund balance in there that if we run into a situation where state doesn't pay us, or again, if there's a property tax freeze, that's an avenue for us to be able to meet our cash flow, because we would have some low points to where we could actually transfer those funds to help again pay our bills for the year.
All right. Tort immunity, that's not a term that maybe most people are familiar with, but
the tort is a liability fund where we pay our general liability insurance out of. We have our security staff come out of that particular fund, and it pretty much will, again, more of the insurance side of things for that particular fund.
All right, and then fire safety, hopefully feels self-explanatory there, but
yeah, again, it's to support the safety of the buildings.
Okay, and again, we just wanted to throw that in there just to again explain that it's a pretty complex process, and where all these dollars sort of are sorted.
And here's a little bit more detail on the recommended levy. On the left-hand side, you'll see a 2016 actual, and then on the right side, you'll see 2017 projected. And this is the balloon levy. This is where we're asking for more than what we're going to receive, and we know that. But this will allow us the opportunity to go ahead and literally move some pennies between funds to help balance that fund out in the budgeting process. And again, you can see last year the CPI was 0.8, and this year it's 2.1%. So overall, we're looking at an operating rate, or total rate, I should say, of 4.907768 for our district. And that, again, that represents about a 4.73% increase. Again, I'll remind you, this is the balloon levy. This is not what we're actually going to receive. And then we put some sample impacts of what it would look like for a couple different valued homes. This valued home is about $161,000. And if you look in the lower right side, it would show an increase over the prior year of about $110. Again, this is only an estimate because there's a lot of moving parts to this process. And one of those are if there's a lot of appeals on your home values, or corporations go and try to fight the value of their properties to get them reduced, that has an overall impact on everybody else, which means that you pick up the difference of what we would lose by somebody having their assessed value lowered.
Right. We'll show another different priced home, similar sort of charts, but
and again, it's $212,000 for a home in Grayslake, and approximate increase just for District 127 will be about $150. That some of that is the bonds. It's about $30 just for the bonds themselves.
Right. And that $149.63, that's not per month.
That's an annual amount. That's correct.
Okay. Just wanted to make sure that's clear. It's not every.
Thank you.
All right.
This chart shows what our current debt service payoff will be, and you can see that we only have a few years left here. And if you look at the column that says taxes paid for debt for $200K home, that is just a portion just on the bonds for somebody that owns a $250,000 home. And we know that once the bonds are paid off, or you can see how actually it's a sliding scale, that it declines over time, and then our bonds are paid off. Even though that amount will go down, for again, example, the $250,000 home, that $618 after the last payment's made will reduce your taxes. However, it won't probably reduce it by that amount because of the other taxing bodies. And just want to remind people of that. This is only dealing directly with, District 127 and what the impacts of the levy and bond payoff will be for you.
Right, yeah, so this is just, it's purely an estimate. All of these are estimates. But just demonstrating how that bond and interest tax rate is going to drop off in a couple of years once those bonds are paid off. And yeah, the estimate of going from 880 to 924 to 881, 659, and 618, and then that portion of what we're levying drops off. But as Mike said, yeah, we can't guarantee that somebody who owns a $250,000 home is actually going to go down $618. On our end, that's what we're anticipating, but there, as you saw in some of the other charts, there are plenty of other taxing bodies in the area, and we can't really control what they do.
Again, here's another chart that, starting with the next levy cycle, the bonds will be paid off February 1st, budget year 2021-22. And you can see that on the chart, it says 2020. That's levy year. And there is a difference between the budget year and the levy year. So that's where the people get a little confused on when the payoff is going to be. And again, just to remind you, it's going to be February 1st for the budget year 21-22. Last levy year will be 2020.
So that's about all we have. As you can tell, the levy process is very complex. Educational finance is very complex, so we tried to make it as simple and easy to understand as we could. But we do definitely want to thank you for supporting our schools, supporting all of our programs. Again, whether it's academic or athletic or fine arts or support programs, everything we do and everything you do to support our schools, it goes to support kids. And that's what we're all about. And so once again, we want to say thank you.
Thank you again very much. And let us know if you have any questions. You can email either Mikkel or myself.